Welcome, the Fortune Builders family, the Not Your Average Investor Show family, as we all come together in our monthly tradition. It is good to see you all here showing up. I'm your host for the show today, Pablo Gonzalez. I've got a couple of big-time experts here in the world of real estate that have been working together for 19 years as a yin and a yang. Of course, we have my usual co-host on the podcast that we host weekly, the Not Your Average Investor Show. I call him GC because he's got these genius concepts, knows how to generate cash flow. He's a great co-host, and because his name is Gregg Cohen, and I got tired of coming up with different variations of GC. What's up, buddy?
Hey, buddy. Great to be here. How are you?
I'm good, man. Good to be.
Fantastic to be with all of you.
Yeah, good to be here with everybody, and of course, Paul Shively, Passive Income Club luminary. You are the leader of helping folks invest passively, build different forms of wealth through real estate. Each of you guys have been a part of billions of dollars of wealth creation individually. And of course, the Fortune Builders and the JWB story is essentially been very tied together for many, many years. Oh, yeah. Paul, you want to say hi? We didn't even get you to say hi.
That's all right, man. No, I'm excited to be here. Like I said, every time it feels like coming home. Anytime we get this group together, which is great. I love bringing this group specifically to our mastery students. So, hey, everybody, mastery, good to see you again. Love bringing this group to you because we're trying to, tons of education, specifically on the rental side, specifically on passive income investing. And today's show, I'm really, really excited for, right? Because we talk a lot on the show. I'm guilty of it. We talk a lot about like my stories and my portfolio and try to relate stories to help bring education to everybody. And Greg, you do it too, which is great. We bring, last month, and if you haven't seen our previous shows, we'll show you a text number in a little bit. We can get you all of our previous shows. We can get you all that stuff. But last month, Greg did a great job talking about markets and how to pick a market and how you want to think about a market. And today's really fun. I'm, don't want to overstep my bounds here as kind of one of the color commentators, but we get to talk about you, Pablo, which I'm really excited about, man. It's going to be great.
I'm excited too, as we were kind of prepping for the show, and you're like, "Man, Pablo, that was a really good decision." I've had the great fortune of just being surrounded by a couple of folks like you, a couple of folks from our Not Your Average Investor Show and Fortune Builders community. So I just got the good fortune of talking to so many real estate investors, and today I get to share my story. I'm pretty new to this game, right? I've only been doing it for about a little over 3 years, maybe. I've got 3 properties, and right now it might feel like prices are high, mortgage rates are high. And that's scary. And are we at the top of this thing? And there isn't enough cash flow happening and all these different things. But I'm going to share a story of, I got this 3-door portfolio, and there's one house that had the least amount of cash flow when I bought it. And it's become my best investment I have ever made. So we're going to talk about all that stuff from my own little personal perspective here, along with everybody else. And I just want to encourage everybody, if you're a Fortune Builder student, if you're a Fortune Builder student, just know that this is part of your program, right? Like JWB is the rental property investing, one of the rental property investing arms of Fortune Builders. And you guys have been doing this for a long time. You guys want to give a little bit of scope of just kind of like how you guys have worked together for so long?
Yeah, I'll jump in there. I mean, we talked about how you felt very fortunate to be surrounded by folks to help you come into this asset class. Well, that was my experience 19 years ago working with the Fortune Builders team, except it was the Fortune Builders team before it was actually called Fortune Builders. I had the good fortune of getting to know Than Merrill, Paul Shively, Conrad, Paul Shively, the folks at Fortune Builders who are responsible for helping literally thousands of people enjoy success in real estate. And guess what? I was their guinea pig 19 years ago. So talk about good fortune. I think people come into my life in order to help me. And I just hope that I am humble and wise enough to be able to take that mentoring. And I had that with the Fortune Builders group. So I learned a lot about how to invest in single family rental properties from the best in the business. And, and then we of course fell so much in love with it and so passionate about helping ourselves do it, but also helping others do it that we started our own company, which is JWB. And that was 19 years ago. And, that was, about 1,700 clients that we've been able to help since then. We get to manage $1.3 billion in real estate, get to manage 5,500 rental properties, all in hopes of creating better outcomes for our investors, better financial outcomes, better life outcomes through this beautiful asset class. So Shively and I have been brothers in this since the very beginning, and we've had the opportunity to witness so many success stories, and it never gets old, right, Shively?
It's why we keep doing what we do, right? My wife was asking me this morning, like, oh, what's your day look like? And I get this smile on my face, right? And because today I get to record this and do this with you guys. And I don't get to do that every day. It's about once a month we do this. And it's one of the best days of the month because I love what we do. I love the mastery community. Been a part of it for, gosh, almost 15 years now myself. Be fortunate, like I said, to lead the Passive Income Club and help, close to 6,000 families do what we're talking about today, which is great. So I'm excited. I love it. Let's get into the case study. Let's give people what they came for. I love it.
Let's get into the case study. But since we are talking about real numbers, we're talking about my investment portfolio. GC, I think you got to give everybody a little.
Yeah, just I want you guys to do your own due diligence. We are going to be sharing numbers here with you. These are actually Pablo's numbers, but I want you to do your due diligence. Think of being here today as the start of your journey or continuing your education when it comes to making a decision to invest. Surround yourself with those who you trust. And I hope you continue to come back to these educational webinars that we do, and then the Not Your Average Investor Show to continue that journey. But today is one step of it, and we're excited that you're here.
Yeah, and I am one data point in this chart right here, right? JWB's been doing this for 19 years. They've created 307 million plus worths of profit for investors like me. I'm one of these guys down here, one of these 763 that has over 100K in profits, as you're gonna learn today. But this is a track record. It's one of the big reasons why I invested with JWB after getting to know their community and meeting a lot of these folks that have actually, that whose names aren't here, but I know who these people are, right? So that being said, the best thing that you can do right now is lock in, pay attention. You're going to get the slides. You're going to get everything. But text this number, 904-293-0341, because again, it's part of your program already. What JWB does, if you text this number, they'll set up an appointment and they will talk through this idea of how you build a single family home portfolio in order to meet whatever objectives you have. If you want to pay for your kid or your grandkids' college education in the next 15, 20 years, they can help you build a plan for that goes through real estate. If you are worried about medical bills when you're older, they can help you build a plan. If you, right, like all these different things. If you just want to retire with real estate in your portfolio and you have a certain income stream that you want to hit by a certain date, they build outcome-based investing plans specific to the target that you are trying to hit. They did that with me, and they've done that with all these other folks. So just go ahead, text 904-293-0341, 904-293-0341. If you need that number again later, Joanna will put it in the chat. But let's talk about this, right? This is a true story of going from just completely break-even cash flow in a single-family rental property to over 100K in profits in my portfolio, and how I made this decision and how it's worked out and how it feels.
Yeah, and I mean, what's cool is here we're going to talk a lot about live numbers that are very real, and everyone loves case studies. I think to frame the case study, and I'm actually curious about this, Pablo. We're kind of doing a little prep on the show, and you're starting to tell me your why. And I'm like, hold on. I've actually never heard this before. Out of all the shows we've done, which is amazing. And again, if you haven't seen the previous shows we've done, you can text that number that we just did. We can get you previous shows, right? We can get you a lot of this where we give you market data and financial engineering numbers and how to analyze properties and how to do all these awesome, cool things in real estate. This show is really a case study, right? More of a mindset thing, which is great. So I'm curious, Pablo. I've never heard out of all the shows, and I'm guilty of this because I wasn't curious enough. So I'm going to be curious, man. Yeah. Why? What were you looking for, right? Like, tell me your story. Like, not everyone chooses to invest in real estate. Why did you want to start?
I'm glad you finally asked, Paul. Listen, I'm what you would call a, they talk about accidental landlords. I'm like a happenstance real estate investor, right? That whole, you surround yourself, that you're the average of the 5 people that you surround yourself with. That's real for me because I was early on in my entrepreneurial journey. had this vision for a company that I wanted to build, and I saw this dude as like an ideal client, right? So he hired me to do this podcast, and we, like hatched this plan. And as I was doing it, right, like I had just moved a year ago from Miami to Jacksonville, and I had lived in Miami through, the early 2000s when you could pick up these like properties for like $150,000 that everybody was just like, Weston, what is this place, right? That are now worth $800,000, $1 million, all these different kinds of things. And I remember at the time thinking that that was really expensive. And then, you remember the years of like the early 2000s, it like stuff just shot up and it got out of my like price range really, really quickly. So I had moved to Jacksonville a year prior. I loved living here. I knew I wanted to make a home for myself. I knew that real estate was going to do very well here. But because I was just kind of like starting my entrepreneurial journey, I had money to buy a house, but it wasn't money to buy a house exactly where I wanted to live. And I made the mistake in Miami of just like not buying something back then and then moving around a bit. And then I never had the chance to buy again. So my original why was I want a piece of this real estate market because I would go on these runs with Gregg in the morning when we're like prepping for the show. And I'll say, Gregg, I think I need to, we talked a lot about like, I'm still renting, but should I buy something? Because my thesis was I need to invest in real estate now, or else I'm never going to be able to afford a house close to the beach here in Jacksonville if I don't start just like at least attaching myself to it. And then, I expect business to do well, blah, 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 blah. But I also want to have options later in life, right? So like it was twofold. I wanted to supplement later in life income to not be beholden to like, hey man, if this like my own company thing doesn't go well and I got to go get a job, I just don't want to be like totally beholden to it. But the biggest thing was, man, the pattern recognition of having been in a market that I knew had the goods and I didn't have like the perfect reason to do it, and knowing that I needed to just start to put money in it so I would not get left behind. I thought that at some point I'd build a small portfolio and then I'd sell it all and buy my dream house, honestly.
Okay. Yeah. I love that. And that makes a lot of sense. I love there. What I heard was, and you correct me if I'm wrong,
Yeah.
because this is what the phone call is really going to be like when you text that number and you start to build the plan. Our job is to help build a plan for Pablo, which we did, right? And Gregg did a lot of this work, right, one-on-one with you, which was lovely. And I'm kind of coming in the back end of it. But when you text the number, this is what's going to happen. They're going to ask you, well, what are you looking to do? And it's going to be this back and forth. And we got to make sure we get it right. So Pablo, what I heard is like your short-term goal was you wanted to put dollars in to take advantage of what you had already seen in Miami as the rise and the appreciation, the growth, right?
Yep.
But you also had that was short-term goal. You also had a longer-term goal, which I'm curious now where we are on it, but we can talk about that later, is, okay, you had a long-term goal, like you said, I want to buy a dream home. I want to get next to the beach as well, too, right? So that was the long-term goal. Okay. What were you afraid of? What had made you not buy real estate before, right? What made you not pull the trigger in Miami that you had to get over, right?
I didn't know, I didn't understand property management, right? Like I didn't understand this idea of, back then I was early in my career. I knew I was going to move around some. And I was like, if I buy this and then I move, what am I going to do? Right. So like, I just wasn't comfortable with that. I was afraid of buying my own home in Jacksonville where I wanted to live because I didn't know if I could afford it. But thanks to hosting the show, I realized that it's different when you buy a home where the cash flow pays for itself and you really, really trust the property management company, right? I'm not a guy that's going to go plunge a toilet or anything like that. And, I had been, as the host of this show, I get to be in their like meetings and all these different things. And I was afraid of like of a crap property manager. I thought it was going to be like my realtor aunt that was going to be managing my home. I wasn't down for that, seeing a 100-person company that's been on the front page of the Wall Street Journal manage my home makes me feel way better.
Sure. You didn't want to fix toilets and deal with tenants and doorknobs and have to go see your property on a Saturday afternoon to fix something, right? Yeah. And that confidence would work. Okay, I'm with you. When you started this journey, talk to me about because maybe now it might be different, because this is 3 years ago, right? Like, rank what you were trying to do, like, in order of importance for me. What were the top 3 things you were trying to do? You kind of mentioned it a little bit, like you were trying to get in on the growth, it sounds like.
Yep.
But like, where was like cash flow in that ranking of 1 through 3? Where was risk reward in that ranking? Like, where, talk me through what were you trying to do? I've got the vision. Now talk to me about the short-term real estate. How did you look at it? Right.
Yeah, I looked at it, Paul, as I had money that I had like set aside, and I knew I could access some other stuff after like understanding kind of like the dynamics in real estate, and I wanted to put it to work for me, right? Like, and it was one part. I want a piece of this upside, right? Like that was number one. I want a piece of this upside. I knew that I wanted cash flow at some point in the next like 15 to 20 years. I didn't want to be beholden to my boss or beholden to like my current way of gaining income. Like I wanted some like, or my, honestly, it was, we're guys, right? So we're like, I think I can do anything. But like, I was like, I don't want my wife to feel like she's got to be an architect full time if she doesn't really want to. Right. So like, I wanted to create this like secondary income stream down the line so that like, as I enter my 50s, I'm not, like, I'm not needing to take a crap job and I can, if something happens, I can take some time off. That was my second one. And then third was this idea of, I just don't see any other way where I can put my money to work for me in a way where I really think that in the next 10 years I can buy a beachfront, like a beachside beach cruiser, put my board on my bike and go surfing home in Jacksonville.
Got it. Love that. And Greg, feel free to chime in here. But what I love to hear, and there's great detail in that, which is great. And that's what the level of detail we love to hear, because that's really clear to me. Like, how you view cash flow was really important for me to know, and for you to know, Greg, I'm assuming, when you built this 3 years ago, because like what I heard was cash flow was actually really important to Pablo, which was great. The timeline, though, really mattered. It wasn't necessarily you needed cash flow now, because you had other income streams, right? And if we were really doing this, and need to move on to get on with the show, right? But I would spend another 10 or 15 minutes understanding, well, where are your other cash flow streams, and how much is actually coming in elsewhere, to know, how short time frame do we have to generate cash flow? Is it a year? Is it 3 years? 5? When do you start to want to access that? So it's great for me. It's like cash flow is important, but what I heard more was like stability and predictability in the cash flow that actually provided security for your wife to not work if she doesn't want to, or her job becomes a headache, she doesn't want to do it anymore, all those things, right? So it's like predictability and stability of it in the future, not necessarily now. But really primary was get the dollars in and growing, right? Yeah.
Man, I've just loved being a fly on the wall for this conversation, because we got to have run after run after run. And this is the culmination of probably, 2 to 3 years of running, is what we kind of distilled this down. And from this conversation, my team then takes, okay, we want to make sure that Pablo can buy that house that he wants. We change that into a financial goal. And then we understand the timeline, and we understand how much cash flow does Pablo need by a certain time. And then that becomes the goal. And then you've got 130 plus people working towards that goal for Pablo. But what I remember about these runs as well that we would have is, for a long time, this didn't make sense. Like, it makes sense now when we're going through this, but I remember run after run where you'd be like, yeah, like, I just don't get why would people be so excited about like, $50 a month of cash flow? Like, I just don't get it. And you're a super smart, educated guy. And you would talk to me about your friends.
Chris Kraft.
Yeah, your friend Chris. You'd say, listen, man, I went and I talked to Chris about what I'm so passionate about helping share the message for. And Chris is like, that doesn't make any sense to me. And so can you talk through maybe that moment before it made sense until when it clicked for you that it made sense? Like, what was the difference?
The difference was, I remember you being like, yeah, man, but then you don't get this like equity piece if that's what you're doing, right? Like we kept talking about, there was a private loan product that I could do that would just give me like 10% back. And I was like, why would anybody not just take that 10% cash flow as opposed to the home, which was a little bit less cash flow at that time of like what was available. And you were like, well, because in time this stuff appreciates. And then I learned the concept of leverage, right? Like it wasn't just home price appreciation. It was home price appreciation plus leverage,
Right.
which really turned me on, right? Like this idea that if I'm putting down 20% on a house and I'm putting $10,000 down to a $100,000 home and it goes up 5%, then it's not really just 5% that it went up, because 5% of what I put down, because those $5,000 of $100,000 is actually 20% of what I put down. Right. So like that was the thing that really clicked for me. I was like, oh, this thing actually has a way to get my money working much harder for me than if I was just like asking for a specific return on cash.
Yep. And we get to teach more and more on that. So if you're curious about that aha moment and you're like Pablo and you're like me and everybody else, it takes some iterations. Yeah. But understanding the depth of this asset class is important. Understanding all 5 profit centers is important. Because guys, if you're like most investors out there in real estate or in rental properties, you probably heard cash flow, cash flow, cash flow. Well, what you're hearing from Pablo today is cash flow today was not even on the list of things that was important to him. Right. And you'll see how this is reflected as we get into the case study here. So really fun to go through that journey.
Okay, can we talk about my properties?
Let's do it.
Let's go. All right, so here are the first, right? I bought a property in February 3rd, 2021, and then another one in May 17, 2021, and then one in July 6th of 2022. So these first two, you'll notice have a much lower price, right? Like at this point, I was just like, I got a couple of bucks. I really just want to get into real estate. Interest rates were low. Price was low, right? And I was just like, all right, cool. This is kind of like my dipping my toe in, and I was able to do this thing. It got a little harder as time went on, right? Interest rates went up, and I knew that they were going up, right? I knew that we were headed into that era, and I also didn't know how I felt about the et al. Economy, right? Like I had like my own theories around like what the stock market was going to do. And I had this moment where I was looking at this point, I was like, I'm in. The Jacksonville market, I completely get it, right? I've been saying it since I moved here that this is Orange County, California 20 years ago. I've now been here for 5 years, so I feel like it's Orange County, California 15 years ago. People would laugh me out of the room when I would say that in Miami. And now everybody kind of is like understanding this about Jacksonville. But I got the market. I understood why this place was going to do so well. And then I was learning more and more about why I was doing well. So then when I reached this moment in 2022, interest rates were higher. I wasn't going to be able to put down 20% to get cash flow. I had to put down more. And yet I had the option to buy another home for like 170 or had this home for 230. And at the time I thought to myself, okay, this was the moment. This is like I wanted to get to 3 homes. I wanted to build a little portfolio. And I knew that this was going to be my last push into real estate for at least a little while as my business was taking off and my active income was going to increase, which by the way, I'm there now, right? Like we were just talking about, I'm looking about adding another property right now, but I knew that this was kind of like my last go for a little while. And I remember telling you, I was like, man, Greg, I'm just going to go with the bigger property. Like there was all these other things around it, right? Like the neighborhood was cool, whatever, all these different things that people were telling me about it. But like my decision was, I know that in real estate, it's time in market, right? Like I know it's not like wait to buy real estate, it's buy real estate and wait. And I was, to use the term that I had learned from you, I was pulling forward demand. I knew that I wanted to get to a point when I'm older where my real estate portfolio is about 60% of my net worth. But for right now, I wanted it to be 95% of my net worth because I wanted in on it now. Because I didn't know when the next big contribution was going to be. So I just wanted to push more of my allotment of capital into it. So I bought the biggest house I could afford that was cash flow neutral at the time.
So much here that I want to stop because there's a couple of points that I think are just really critical and are different than what the average investor thinks. That point right there where you're looking at this and saying, I'm going to financially engineer my outcome to put a certain amount of dollars into this asset class. Mm-hmm. Not enough rental property investors think this way. Yeah. They think that way when they're talking about buying stocks. or bonds. They're like, oh, I'm going to put X amount of dollars into that. They don't say to themselves, I'm looking to buy X amount of shares of something.
Yeah.
But for some reason in rental properties, we say, oh, I'm going to buy this many properties. At the end of the day, what we're talking about are dollars, right? And if you have an investment that you believe in, if you have the opportunity to put that right amount of dollars into it, it really doesn't matter if it's 2 houses, 1 house, if that house is more expensive or less expensive. Because now you had 2 properties that you knew the model worked. You had even more trust in the team that was supporting it. And now you had the opportunity to have less out of pocket or more out of pocket. You chose more out of pocket because you wanted to get a certain amount of dollars active in the space. That is really cool. And not enough people feel that way. Ultimately, at the end of the day, it's dollars and a return on investment. So I think that's really cool. And then what we did, we talked a lot about the power of front loading this asset class. When you're talking about getting more of your wealth into the asset class now for a better financial outcome later, that's front loading. And the beautiful thing about rental properties is that if you look at what you want to achieve later on, a certain financial goal, and you front load that, this asset class has 5 ways that it pays you, and they all get better with time. So ultimately, front loading is a great idea to put more of this asset class in while you're younger, because then it just gets easier to hit those goals later on. Rather than if you start late, you don't get the benefits of principal pay down as much, home price appreciation, tax savings, those sort of things. So very different concepts that, again, if this is your first time hearing this, this is the value of that call with my team. We can go more in depth into this, but this was probably 3-4 years. It was probably 2 to 3 years after we initially started talking that now this started to make sense for you, and you start to see it, especially in that third purchase that you made.
Yeah. The third purchase was in. I know that you hate me saying gambling analogies, but I was just like, this is my moment to push all in something I really, really believe in, right?
Yep.
So like, I really just took. I remember I cashed out an old IRA, right? Like I cashed out an old IRA. I took the penalty on it, and I told myself I wanted to have as much as I could in this thing that I really believe in, that I know is going to make my money work hard for me.
And let's just talk about what the cash flows were, since this show is talking about going from break-even cash flow. So I would say for the Minosa and Lucky properties, they were a little bit more for cash
like
flow.
150 to 200 a month.
Yeah, sure. And that you would tell me, listen, that $150 a month or whatever, not going to change my life today.
Correct.
But it has the potential to do that later on. Right, the property on Katina, we had to put 25% down just so that would be break-even cash flow.
So it
right?
break even. It was like $25 a month.
Right.
Like it was very little. So that's kind of the journey. A couple of questions here on, just out of curiosity, were these cash flow neutral with property management in place? Yes. So when JWB brought me these properties, the pro forma had everything in place. They approached it from like an IRR standpoint of like where it's going to be in 10 years, with everything in maintenance speculation, like maintenance estimates, property management, every single cost, including what I would have to like pay in closing costs to like sell a home if I wanted to exit in 10 years. And that kind of brings me to what E. Jordan is asking, is how do I find the right property management company? What I realize is, I've learned to look for a couple of things. I've learned to look for property management companies that are a big company, right? And I've been around for a while, and the data in the pro forma, the data in the offer needs to be proprietary data, right? Like too many folks will just take like a number out of Google or ChatGPT, or a number that they paid for that is, this is what the average says here in the market. There's a couple of property management companies in the world, JWB is one of them, where the numbers are, hey, over the last 17 years, this is exactly how our homes perform, and we've widgetized this asset, which is something that, by the way, I didn't talk about. The reason why I went big and I could think about it in numbers is because we talk so much about the widgetization of the asset class here. Because JWB has been in Jacksonville for 19 years, building in the same types of neighborhoods, the same types of homes, same type of construction, and they have this data flywheel, they've been able to just say, oh, a $130,000 house or a $250,000 house are going to perform to the standard that we make it perform at. And therefore, I really, really believe those numbers. I also had the luxury of being the host of the podcast and talking to like 2 to 3 people a week that were experiencing the same results.
There you go.
So,
And I want to jump in here real quick and just pause this, because this is great. This is absolute gold for the community to hear. Because Pablo, everything you talked about, and Greg, you kind of walked him through, like, how did you make this specific decision when you had, because you were at a little bit of a tipping point here, right? It was cool. You see, the first house had a little bit of cash flow, right? $100 a month or something, I think you said. The second house had a little bit of cash flow, probably somewhere around there. The third house, when you were looking at it, you had an option to go something a little bit cheaper with a little more cash flow, or specifically choosing break even, right? And that is a huge point I want to drive home. But when I'm hearing you of how you made that decision, it wasn't transactional, your thought process. It was very financially astute decision-making. What I would call like financial engineering mindset, something I've taught about at all the rental property boot camps for the mastery community for 15 years. It's something Greg has helped teach me about as I've grown up in real estate. I used to be very transactional. Let me analyze this deal just on the merits of its own deal, and it's deal focused, right? And a lot of real estate investors are very deal focused. And you can do fine that way. That's okay. There's nothing wrong with that. But the secret to, frankly, what a lot of the hedge funds have figured out, what a lot of the big money dollar investors have figured out, what a lot of the true wealth in real estate has figured out is if you can do exactly what Pablo just said and learn to look at the asset class, houses, single family houses, as a widget, like Pablo just said, and find a company that can help produce, okay, this is what the widget does. The widget does X, Y, and Z, right? In this particular case, happens to be real estate. We rent it, it performs, our tenants stay in X amount of years, rattle off the data like Pablo just said on the property management side of, okay, I have this widget. What's the data of how it's going to perform over a large period of time, like JWB has? I can predict the future. Then it becomes math. And this is where I personally get lit up and excited, because Pablo's saying, okay, I know what the widget does. I see how it's going to grow. I know the appreciation rates. I just need my dollars to get into this widget, right? And that's a financial engineering conversation rather than a very transactional conversation, right? And how do you get to that point? You get the education like you're getting now. You get the education by jumping on the horn, listening to these webinars, joining mastery community, all of those things. But that probably is going to commend you. Like, that's an advanced mindset, right? For someone who hadn't owned a lot of real estate, it's a really advanced decision-making process. So kudos to you, man.
And I just wanted to highlight here, a lot of folks will say, listen, this sounds awesome, but I just don't have the money to get started. I think it would have been very easy for you to say the same thing, right? I mean, you were just starting your company at that point in time, right? When you're starting a company, for those of us who have done it, even when you're making money, you're not bringing money home. You're pouring that right back into that company. And you don't know where the next bucket is coming from. So that's the power of working with folks who have done this over and over and over again. You jumped on the phone with our team. We were able to unlock some things that allowed you to move some money in some places around. And when this made sense for you and your ultimate goals, wow, the money was there. So that might be a similar situation for you. It may be sitting there and you might not know it. It may be 1 degree away from you. We might help you get it. But I've said this for 5 years doing this podcast. If the only thing holding you back is the money, that's actually the easiest problem to solve. So if that's where you find yourself, definitely get on the phone with our team. There we go. 904-293-0341. Text us.
Got it. All right. So why don't you dive into this actual property, GC? Because it made me look pretty good to my wife.
There we go. Well, that's our job here at JWB. So here's the actual home here. And again, Pablo has owned this for about 2.5 years. This is the third property that we just looked at. This was the one that we're focusing on because this was Pablo getting excited about buying a property at break-even cash flow. And so in the original estimate that Pablo saw for this property, we estimated that the cash flow components that really hit your bank account, which are cash flow and tax savings, it'd be roughly break even, a little bit positive. So on an annual figure, it was $864 is what we estimated for positive cash flow a month. What's that? About $70 a month, right? So certainly not something that if all you understood was cash flow and you were making your decision with those cash flow blinders on, you'd probably say, hey, I'd be on to the next one, right? Principal pay down, another one of these profit centers that we talk about. We explained how this is going to have your resident pay your loan off for you. And in the first 2.5 years, that was going to deliver about $5,800 of profit for you. Again, if all you're thinking is cash flow, you don't get this concept. But let me tell you, $6,000 of your loans being paid off really matters. And then we talked about home price appreciation. We talked about how you can bet on home price appreciation if you are working with the right team in the right market and you have the right timeline, right? Pablo's commitment here was that he was going to buy and hold. And we talked about how home price appreciation is actually predictable when you invest for a full market cycle. But the thing about this is we are all about under promising and over delivering. And even though we had a really good feeling that home price appreciation was going to be quite high and beat averages just like we do, we think as well going forward here, we estimated what the average appreciation rate was for the last 40 years when Pablo bought his properties. That came out to an estimate of about $27,000 in home price appreciation. Now, I'm just going to pause there for a second. We estimated that you would have made $34,000 in the first 2.5 years for your property. Out of that $34,000, $27,000 of that was going to come from home price appreciation. So when we're talking about how important it is to choose the right team and the right market, it comes down to just this original estimate for me right here. Because if you choose the right team, that's going to keep you in the game long enough for home price appreciation to work for you. And you have to choose the right market. And if you're curious about how to do that, we've done many trainings on it. So again, reach out to us. Our team will get you those trainings. But Jacksonville is a growth market, and it's been substantiated through that data. So $34,000 is what we estimated that we would be through 2.5 years. That sound about right?
Yeah, so that's what I was betting on.
There we go.
Yeah.
Well, as you would imagine, we've actually done a whole lot better than that. So I pulled the numbers of actual performance, and Pablo has seen this as a part of his quarterly reporting that we share with all of our clients, but I don't think it's ever been this front and center for you, has it?
No, this is awesome.
So actual performance of cash flow and tax savings, this under promise and over deliver core value that we care so deeply about here at JWB and for our clients, this is on display right here. We estimated about $860 of positive cash flow through the first 2.5 years, and we have delivered over $8,000 in positive cash flow. Pablo, how have we done that?
Well, I haven't had a turn. This is again, it was the biggest properties that I bought. It's got a family in there that had been there for like 10 years or something like that before I even bought it. And when we bought it, I was fully expecting them to turn and then to bring the rent up. But once their lease expired, it didn't turn. They stayed, and we raised the rent. The rent went up like $500 a month. So that's been amazing.
Yeah. And
Yeah.
Shively, you and I were talking about this concept of rents growing over time. And you and I both feel like people just totally either dismiss that, don't understand that, or devalue that. Could you share your thoughts on that for me?
Yeah. And I was very guilty of that early in my career, right? When I first joined Fortune Builders and Tham was teaching me and Paul was teaching me, and they're teaching me how to look at a deal. They had showed me how the life of the real estate is really a 10-year cycle, 15-year cycle, and you want to be in for. And they showed me rent growth, but I was young, right? And still fairly young, still trying to be always learning. And now that I've owned a lot of my real estate for 10, 15 years now, I can tell you a story of one of this isn't about me, but one of the properties I bought had the same exact thing happen. I bought it just off year one cash flow. And I had very little, but I bought it for the same reasons that you did, Pablo. And actually went back and analyzed it after we started prepping for this call. I went back and analyzed it. I haven't really paid attention to it that much, Greg, sorry to say, because your team's doing a good job down there. But my rents have grown just like yours have, Pablo. And I've owned it for about 5 years now. And my rents have grown significantly, right? So where I'm cash flow positively, I was break even. Now I'm making about 16% cash on cash just off the rental increases, right? Well, why? I just had to wait 5 years for those rental increases to happen, right? But when I made the initial decision, like a lot of us, we're looking at year one, right? And just like kind of the uneducated investors out there, when you look at anything in a very narrow perspective, it's harder to make decisions. When you have the broader perspective, it's easier to make decisions. You talk about banking on appreciation. Well, people can kind of get a little squirrely on that. Well, let's just go back and look at, like you said, Greg, what is 40 years of data? Multiple market cycles. What do we mean by a market cycle? Housing is going to go up and then housing is going to come down, and housing is going to go back up again. It's going to come down in about a 7 to 10 year window. It's going to do a little bit of both probably, right? And when you can take a large data set, take the average, you can kind of predict the future, right? In the same long data set, 7, 10, 15 years, I can kind of predict the future. You can do the same thing on rental growth rates as well too, right? And that's one thing that people haven't really looked at. And I didn't look at when I first started buying. And it took for me, and did for you as well, Pablo, it took a break-even cash flow year one when I made the decision to a significantly cash flowing asset for me 5 years later, which is phenomenal, right? You can take the same approach to home price appreciation as rental growth. Look at the data. Invest with a company that can show you that data, right? Really, really important.
That's why I love this asset class. You don't have to be a genius to understand. You understand where the money comes from, you understand where the money goes, and there's a ton of data to support this, and it supports that it is one of the most consistent performers, which helps us all sleep well at night. And speaking of sleeping well at night, Pablo, we turned that 120 grand that you brought to JWB in search of an opportunity to buy that dream home.
Yep.
And in search of the ability to drive that amount of income that is going to provide opportunities for you and your wife to be choosy about where you spend your time. We've been able to turn that 120 grand into about $262,000 in just about 4 years. How's that feel?
It feels awesome, man. You know, as I was remembering that I'm gonna like tease Paul with what like my why is and all these different things, like I remember thinking I need to have, I mean, this is real, right? Like I need to have enough money to put 20 to 25% down on an $800,000 home if I'm going to live close to the beach in Jacksonville in the near future here.
Yeah.
Like,
Yeah.
so when you guys showed me this number, you know, when I saw this number and we're talking about what we're going to do, and I was telling Paul, I'm not going to tell him my why yet, you know, like it really, really hit, like it really, really hit that, this thing would have accomplished that. The other side of the story is I've done well. I've become very educated in real estate, and early last year, I bought a duplex close to the beach. So I'm house hacking close to the beach, and now I have 5 doors and I'm living in one, and I got all these like benefits because of that. So, you know, something along the lines of like when you set your mind to something and you think about it all the time, it comes true, right? Like they call that manifestation. I call it the brain is a problem solving machine. And I just had this thing in my head that I wanted to reach that goal. I reached it. And like we talk about a lot on the show, real estate is a super flexible asset. 'Cause now what I have is this $262,000 in equity and like all these kinds of things that have like hit my bank account. I was just telling you, I've saved like an extra, you know, like 30K in the last like 4 or 5 months because I have this extra cash flow coming in. I have this extra equity. And now what I'm looking at is, okay, well, I have my home that I want to live in. I live beach cruiser right to my favorite surf spot. Now I can take this equity, refinance it, and buy like 2 more properties, buy 3 more properties, put it to work in, you know, like in some kind of like lending asset or whatever.
Mhm.
I love these options that this thing brings me because leverage using real estate.
It starts to get even more fun.
Yeah.
It is really fun to see a client go from kind of maybe not understanding this asset class to saying, listen, I want to push these chips in on this asset class because I believe this can be the thing that gets me to where I want to go. And then when you see that success, call it 1 year, 2 years, 5 years later, we come back and we say, okay, how do we take the next sort of advanced step? And that's really where you are right now. How do we do things like using home equity lines of credit? How do we use cash out refinances? Because the advanced view here is, okay, now that I've got money that I've made sitting in equity,
Yeah.
if I don't use that effectively, there's actually a big opportunity cost to letting it sit there, right? So, and it's all in line with your goals, and it would be in line with your goals as well. So, this is the fun part, huh, Shively?
This is, and I said it earlier, is financial engineering, right? But this, what you just described, is the definition of financial engineering, right? And we've been preaching that at Fortune Builders, preaching that at Mastery for years now. Is real estate is a widget, and when you understand, like you just said, Greg, when you understand how the dollars that are in real estate work, how do rents grow? How does the value of this widget grow? Right? When you understand that, and you, like you did, Pablo, how do you get your dollars into that and then predict the future of what's going to happen? Then you get to this point where it's, ooh, now I have options. And that's where financial engineering to, the advanced class, the master class, like you just said, Greg, takes hold. And this is what fires me up. This is why I still do it, right? Because now it's like, all right, I'm super curious. Pablo, you created your dream. You bought the house. You have the duplex there. You live in one. You get your renter on the other side. I'm hoping help pay for the mortgage of all of it. It's great. You're house hacking. You're killing it. So we've evolved the goal, hopefully. So now it's like you have tons of options. You have $250,000 of total portfolio value. What do you want to do with it? Because there's the concept of, like you said, Greg, I call it return on equity. So you have, your initial dollars in and you get a return on it, but then you have the equity too. So what's the equity doing for you? And is it time to tap into it? And that's a math issue. That's a financial engineering problem that we can solve with math, which is great, right? And then we just tie it to your goals. So now it's, Pablo, second version of your why. What are you trying to do now, right? Like, what's the next step? Because then you can take, there's options. You can pull that equity from those houses via a couple different types of loans and do other things with it. Or maybe you want to continue to ride, but it all depends again on you, right? So what are you trying to do now? What's the next step for Pablo, right?
Yeah, I mean, Paul, that was the conversation in our run this morning.
Oh, really? Love that.
That's exactly where I'm at right now. And it really comes for me, it comes down to this thing that we show here, right? Like this understanding that real estate has 5 profit centers. It's got rental income, right? Cash flow. It's got tax savings. It's got principal pay down. It's got home price appreciation. But every time that you map it out on a chart, you notice that home price appreciation on average will be somewhere between like 62 to 80% of total returns. And that thing really hit me thanks to the fact that I got to host this show. And we would have like a investor of the week come on and we go through their portfolio just like they came on with me. And they've been doing it for like 3-4 years, just like I am right now. And we would just map this thing after this thing after this thing. And we started calling it the Pac-Man principle. Because when you put on this pie chart, it really just looks like a Pac-Man. And then the mouth of the Pac-Man has a bunch of colors. But like this home price appreciation piece is the body of the Pac-Man. This home price appreciation piece is the thing that I had to understand that this is better. This is more worth it to me than any kind of like cash flow thing happening because it compounds over time. And it just forces me to do this, particularly in a red hot market that I know is still undervalued, that I happen to know that downtown is about to come online and all these really exciting things are happening because I'm on boots on the ground. My initial thesis was just like, poor people live close to the surf here. Like not poor people, but like my original thesis was like, dude, the middle class here,
all about surfing.
The people that I surf with are like 65-year-old college professors. That doesn't happen in San Diego. They don't live on the beach, right? Like, so I was like, this is undervalued. And then I started finding out all these other market dynamics, that it's the #1 corporate relocation, that it has the fastest rising median wage in Florida. Like all this stuff happening made me really bet on this Pac-Man principle. And that's why I sit here with these options.
And I wish people would understand this.
Yeah.
And then I wish they would match their focus and their decision-making in line with his pie chart.
Yeah.
Right. But unfortunately, the Pac-Man looks very different when you think about how average real estate investors make rental property decisions. They focused 90% of their decision on day one cash flow. But if you manage money like Shively and I do, and I manage over $1 billion of your money, and I see it, and whenever I want, I log in and I see reports, and we report on it quarterly for our investors. and I see all of their Pac-Mans, and they all look the same. And it looks like this. It is home price appreciation is 60 to 80% of your portfolio.
Yeah.
So knowing that 60 to 80% of your decision should be team and market.
Yeah. 100%.
And then, cash flow is like this. It's like less than 10%, right? And that's short run cash flow. That's long run cash flow. Sure.
Today.
Yeah, long-term cash flow is actually 10%, right? Short-term cash flow is like this much. It's like, I don't know. It's a whole lot less. So match your decision-making along with your own outcome. We know how you're going to get there. It's going to look like this. So choose the team and the market that's going to put you in a position of success.
Yeah. So you choose the team and the market, and then there's the asset, right? Like this looks a lot like what I was looking at, right? Like this is the current JWB real estate portfolio. GC, you want to just kind of explain this?
Yeah, absolutely. So each of these assets has the same characteristics that Pablo invested with, right? Our big thing is team, market, and over time, what you're going to see is that the profitability of all 5 profit centers by investing with JWB and in Jacksonville is going to outpace what you could get in other markets. But none of our pitch is we're going to have thousands of dollars of cash flow day one, right? Because it's just not real, right? If you invest in a market that is really high in cash flow today, you know what that means? Not a lot of people are moving there because home prices are low and you're going to have lower home price appreciation later on. So once we got to that place with Pablo, it made sense. And if this is making sense to you, then we would encourage you to jump on the phone with our team as well, 904-293-0341. When you do that and we get to the place where we have understood your goals and your resources, we'll get to the property recommendation phase. And what you'll see for a minimum out-of-pocket expense, including your down payment and closing costs, will be about $50,000 at the minimum. I would tell you to expect somewhere close to around $75,000 or $80,000 for each individual property that you purchase. That's more realistic. 50 would be on the very low end. Your rate of return will be somewhere around 9 to 10%, very similar to when you invested a few years ago. And then interest rates, actually, for working with JWB and our network of approved lenders, we have clients that have recently closed at about 5.3875%. Rates have actually gone down in the last couple of weeks, guys, about a half point. I'm not sure if many of you are aware, but it's nice that interest rates have come down. And we do have multiple JWB incentive packages available currently. Guys, for March, for all the properties that go under contract in March, we're offering up to $12,000 of incentives per property. And I see some friends here in the chat that have just purchased their properties. If you guys want to announce yourself, that's pretty cool. I see one already. But these folks have already taken advantage of these incentives on a per property level. So for every purchase, you're going to get between $4,000 to $6,000 of what is called a maintenance credit. What this means is on your first statement, you're going to get a check from JWB. It's between $4,000 to $6,000, depending on your purchase price. And that goes to cover your first years of expected maintenance cost. And we know this is the most painful part of rental property investing. So it's nice for you to have that cash in your pocket to take care of those maintenance items. And that's on every property, no matter how many you purchase. For those who want to purchase 3 properties or more at one time, there's an additional incentive. It's an additional $4,000 to $6,000 towards your closing costs on your property. So now that drops your out-of-pocket and increases your rate of return. And again, all of this is available for those who put properties under contract during the month of March. So I'm glad we're doing this on March 6th. You guys have some time, especially if you're a new client. Get on the phone with us. It does take a few phone calls for us to make sure we're doing this right for you. So I would encourage you today to text that number and set up that phone appointment so we can start the journey with you.
Got it. And again, text it to start the journey with you, with you. And we host a show every Tuesday. Join us, right? Go to nyas.com. This is where I got my education from. This is where I met everybody that's been doing this thing and completely changed my life. What do you guys think we get into a couple of these Q&As right here?
Let's do it.
All right. Vincent Barbarites, Man of Steel, says, yeah, I'm closing on 3 more JWB properties in the next few days and have been contemplating the rate buy down. Understanding no one knows where rates will go in the next few years, can you touch on the process of considering whether to buy down the rate, how much to buy down or not buy down at all? Basically, evaluating if cost of buying the rate down will be recouped prior to the time of refinance. Is it an option to just go cash flow negative if you're anticipating a refinance in the next 3 to 5 years to pull out equity, rinse and repeat?
Yeah, go for it, buddy. I think I know your answer. Go for it.
Yeah, I've lived this, right? Which is why I think it's a great question. So when I look at a piece of real estate, right, if I know my total return is what I can predict, my appreciation, my tax savings, the cash I pulled out, all of these things, I personally, this is a personal decision, personally am not scared of going cash flow negative on a month-to-month basis, right? Because I know where my finances are. I've got enough cash flow from other sources. I'm okay with that, right? So cash flow negative doesn't scare me because of everything we talked about, right? Greg, you can add to that, but it's, you know, the decision is ultimately up to you and your overall where all the other cash is coming from, your income, all these other streams to make sure you're safe and sound. But cash flow negative is not something to be overly scared about, given if your financial situation is very solid, stable, secure elsewhere. Greg.
First of all, Man of Steel, awesome to see you, buddy. We missed you at the summit. You were definitely missed, and congrats on the 3 new purchases. You know, I don't think there's a right and a wrong answer here. I think what we can do to help you, though, is to give you the numbers for you to be able to make the decision on. So it's actually easy to understand what the break even is for the number of years that you would break even on this. So Vincent, reach out to my team. We're happy to put those numbers together for you. And then, you know, if it's a 5-year break even, depending on how much the rate buy down costs and how much it would save each month for you, then at least you'll be informed and you'll say, hey, listen, well, I'm going to get a refinance in 6 years. So then it, you know, it makes sense. Or I might get a refinance in 3 years, depending on what you think rates are going to do. So let us help you be informed in that regard. But like Shively said, it's really a matter of personal preference and where you want to take a little bit of risk in this, or if you just want it to be slow and steady and not worried about it at all. I don't think there's a right or a wrong answer.
Great answer, Greg. Great answer.
All right. Anonymous attendee says, in my area in California, after 20 years, the city just implemented rent control more severe than the state, and then clicked off. I hear that. I think 1031 exchange, come to a landlord friendly place like Florida. That's like the easiest decision ever. If I had property in California right now, I'd be on with a fully vertically integrated turnkey provider that has an assembly line of properties ready for you to purchase, and just come over here. Appreciation is going to be as good. Cash flow is going to be, you know, like
We just did a training with a 1031 exchange expert, one who we've worked with for almost 2 decades now. So you can just text us if you'd like to get that training. We'd be happy to send it to you.
Got it. JWB is only in Jacksonville, by the way, he is asking. Linda Mercurio is putting something very nice here. I am currently purchasing from JWB in Jacksonville. She just came to the summit. We got to hang out with Linda. She's awesome.
Yeah, she is.
And JWB also does property management. Very easy with them. I try to do it myself in South Carolina, and I was trying to interview property managers. I was on the 3rd one. As the first 2 couldn't return my call within a week, it's unacceptable, right? So that's just kind of like the standard out there.
And, you know, those folks right there, Vincent and Linda, are getting those incentives. So thank you guys for sharing your success stories. And had the opportunity to meet both of you in person. Just, you know, I just love serving the clients we get to serve. I'm so happy for your success, Linda and Vincent.
This is my favorite question to answer, guys. Robert A. says, how do you explain the outlook for Jacksonville and Florida in general based on climate change and future outlook for long-term holds in these areas that will be impacted by the warming of the planet? Will there be a point in time when you suggest not to invest in this market? Robert, I left Miami because I was the director of sustainability of a construction company. I am fully a buyer on the idea that climate change will affect Florida at some point within our lifetime. Here's the deal. Below Lake Okeechobee, Florida sits above a porous aquifer with water underneath it, which creates a very unique situation where you're not just getting sea level rise coming from the coast, it's also coming up from under the ground. It's called sunny day flooding. It used to happen never. Then it started happening every once in a while. In Miami, it now happens kind of like 4 times a year. It's crazy. Above that porous aquifer, it is just like Amsterdam or New Orleans or any other city that has already figured out how to live where the sea level is above the shoreline. It's just keeping it out. It's a feat of engineering that humans have figured out. They have not figured out the whole like thriller video, zombie coming out from under the ground, but it's water thing, right? So what
We just paused. That was amazing.
Yeah.
Holy.
I'm
I
an
had
environmental
no
fanatic,
idea.
man.
I'm learning so much about Pablo right now.
Yeah.
Wow.
Yeah.
Yeah. Anyway, so one of the reasons I came here is because I believe, and I hate saying this, but like, while I do believe that South Florida will get disrupted, and this is not financial advice, I personally believe South Florida will get disrupted within the next 20 years. Not water world, but infrastructure, real issues and costs going crazy. I think Jacksonville actually benefits from that. Right? Because all of a sudden people are going to move north to where that's not happening. They're not going to want to leave the state. They're not going to want to leave the no income state tax and the weather and whatever. They're going to go to the one city that is still has area, is still functioning, is still surprisingly affordable to live in, and that's Jacksonville, right? So like not all Florida is built the same.
I think that is a very profound and substantiated answer. I don't know if I could really improve on that other than to say, you know, when you invest in JWB rental properties, we don't invest near the beach, right? You're investing in single family neighborhoods that were built out largely 30, 40, 50 years ago. They happen to be 30, 40 miles away from the ocean. And there's not a body of water next to them. They're not in flood zones. Almost all of the time they are not in flood zones. And if they do happen to be one, it's disclosed and it still makes sense from a numbers perspective. So long story short, everything you said, that I probably don't know as much as you know about that. And at the same time, we're not investing close to bodies of water.
True. All right, y'all. This was awesome. Thanks for making me feel like the belle of the ball, Paul and Gregg. I really appreciate that.
It's been fun, man. It's been a fun ride for 4 years, and to sit here and to look at the success that you have, it's been great to be a part of it. But it was all you in the beginning, man. You know, you and I certainly did not.
No, you didn't.
You came to me and asked me over and over and over again, and
even this morning when I'm like, should I invest in more JWB? And you're like, yeah, I think you should invest in more JWB. And then later you're like, hey man, I hope you weren't thinking I was trying to sell you anything. Like you're like weirdly like ashamed of like telling me your best financial advice, Gregg. I don't know what's going on.
Oh man, all roads lead back to, yeah, you should probably invest with us. But you know, I mean, what am I gonna do?
But you're right, man. I appreciate the acknowledgement you were giving me. It was scary. Like the beauty of this community is that you've invested in surrounding yourself with people that are doing it like you, right? Like there was nothing more powerful to me than this like weekly learning, and not just weekly learning, but weekly cognitive bias of the person on the other side of the screen has done this. They're talking about it. I can too. The person in the chat has done this. They're talking about it. I can too. Cognitive bias is a very, very big thing. And that's why those of you that have invested in Fortune Builders, you've invested in that cognitive bias. You've invested in that positive effervescent force that's going to push you in the right direction. And you're doing what I was doing. You're thinking about the thing that you want by showing up to these rooms, and your brain will solve for it. The rest of it, the Pauls and the Greggs of the world, you know, like let them be your beacon, let them be your inspiration, but it does have to come from you. Because at the end of the day, this is not the average decision to make, right? Most people's retirement are not doing well. We have all figured out that in order to have financial independence, we want to go into this asset class. So hang out with us, keep coming to these webinars, come on Tuesdays to the Not Your Average Investor Show. We love to hang out with you. Paul, I love hanging out with you, man. I want to go down to San Diego and hang out with you. It's been too long, buddy.
We'll hang out, man. We'll play some beach volleyball. Hang out.
Ooh, yeah. All right. From now till then, we hope to see you on Tuesday's show.
Just one note. Everybody is going to get these slides afterwards. You're going to get a text from my team. So don't worry if you didn't get any of the slides. That's coming to you because we want you to have this information. And
don't be average.
don't be average. See ya.